I think everyone should take the following perspective. At the start of this year, if someone told you that we were going to drop bombs and blow up Iran's nuclear facility and say, what would the stock market do? I'm sure if you were given multiple choice, most people would say the market would be down 20% because they're like, well, we're going to be in a huge expanded war in the Middle East. But over the weekend, that exactly happened. Markets typically sell the buildup to war, and they buy the invasion. And that's exactly what happened today, that markets bought the invasion. So I don't think today should be a surprise because that's the history. I know your inclination might be that the stock market should be getting hammered, but that's not what the history would say.
Tom Lee opens by tackling the biggest disconnect in today's macro landscape: the U.S. Federal Reserve versus the bond market. While Fed officials continue signaling a hawkish stance, the bond market is calling their bluff, pricing in over 2 rate cuts ahead. This divergence isn't just noise, it's a signal that investors see a shift coming, whether the Fed admits it or not. And before that, be the one who says I was here before 100K. I'm on a mission to hit 100K subscriber before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comment. Let's win and grow together.
In terms of the Fed, keep in mind the Fed is talking hawkish, but the bond market doesn't believe them. The bond market is pricing in almost 2.2 cuts now, and it's creeping up. And the reason for that is that the inflation argument and the Fed's intransigence because of summer surge in inflation, that's going to be put to the test soon. If inflation doesn't pick up this summer, then the Fed's got to cut. So I would just think about it as simply as that. And remember, we're already in June, and I don't really see any signs of inflation picking up from any company. With regard to don't fight the Fed, when the stock market fell into early April on that waterfall decline, a lot of people said the market wouldn't recover. Now, you remember the videos we put out? We said that the recovery would be V-shaped. And we said that it's a waterfall decline and you get a symmetric bounce. But the reason people said it wouldn't happen is that the Fed wasn't going to cut or inject liquidity. But guess what? The stock market had a V-shaped rebound without the Fed. I think Fed liquidity is a myth. And actually, this last V-shaped rebound is proof that you don't need the Fed to do QE for stocks to recover. So I'm not saying you don't want to fight the Fed, but the Fed's not fighting anybody. The Fed is just saying they need to see proof of inflation. That's not fighting the Fed. I think you should try to get ahead of the Fed on that. I think everyone should take the following perspective. At the start of this year, if someone told you that we were going to drop bombs and blow up Iran's nuclear facility and say, what would the stock market do? I'm sure if you were given multiple choice, most people would say the market would be down 20% because they're like, well, we're going to be in a huge expanded war in the Middle East. But over the weekend, that exactly happened, but it was, I think, pretty clearly telegraphed that this was a limited action, that the U.S. essentially gave everybody the heads up they're going to blow up this facility within 2 weeks. Iran, I think, was able to take some action and preserve life. So, there weren't people that were going to be blown up. And then Iran did a counterattack that was pretty well telegraphed today, and at targeting a base that wasn't highly staffed. So I think that the adage, and this is an adage we shared to our FundStrat clients over the weekend, and we repeated it over the weekend because there were many developments over the weekend, which is markets typically sell the buildup to war, and they buy the invasion. And that's exactly what happened today, that markets bought the invasion. So I don't think today should be a surprise because that's the history. I know your inclination might be that the stock market should be getting hammered, but that's not what the history would say. We talk about the stablecoin market. I think it's very important to be comfortable with understanding the importance of stablecoins before you make a decision about Circle. So first of all, stablecoins are really important. They are They were originally created as a way to off-ramp crypto into like what would be, cash. But in the crypto world, nobody really had access to a banking account. So it was a really important innovation to actually be able to, you know, uh, own a stable coin. And Tether was the first. Circle is compliant because it does all the KYC in the US. So it is, something that the US is comfortable actually trading. And stable coins are a great business model. They just have to hold a dollar like money market funds, but they can earn interest on all the collected collateral that they have, and that interest belongs to the shareholders of Circle. Um, is Circle expensive? I mean, it reflects scarcity because, Circle's total US dollars is, 62 billion. Um, and it's trading at an enterprise value that exceeds that. So Circle is trading above the dollars of assets under management. Is that justified? Maybe. I mean, it just tells you a lot about scarcity because this is a bona fide crypto play that actually is what we call a rent seeking business model. They generate really good profits with very few employees. So it does have a high valuation, but obviously, it's not going to qualify as a granny shot for us because until it's included in a major index, it's really just a stock we're watching. But if you're interested in finding derivative plays of Circle, I would encourage you to look at a company like Coinbase because Coinbase actually has a revenue split with Circle where anyone using Circle on Coinbase, those fees that Circle receives are actually paid to Coinbase. So Coinbase essentially operates a stable coin called Circle, and they get half the revenues from that.
Tom Lee revisits Fundstrat's legendary Granny Shots portfolio. Built around companies with powerful secular tailwinds, he highlights NVIDIA, added at just $19 and now trading over $100, delivering a stunning 10x return. Tesla is another standout winner. Interestingly, Lee notes that not rebalancing the portfolio had little impact on overall performance until 2024, proving that letting your winners run can be a powerful long-term strategy for patient investors.
One of the things I learned in the 90s was that young people see the world differently than older people. In the 90s, I was a technology analyst looking at the cellular industry, and it was just in its infancy. And many people in their 40s and 50s who were the fund managers thought cellular was just going to be a yuppie toy because it's just a glorified cordless phone. Whereas young people saw vastly improved like life utility by having a cell phone. And in the subsequent years, I found that that was also true about Bitcoin, that when we started writing about Bitcoin 8 years ago, it really resonated with our younger clients, but our clients in their 40s and 50s thought it was just a big Ponzi scheme. And I think that's the reality, that young people are the innovators because they're seeing the world with fresh eyes. I mean, Fred Dyer, who is the founder of FedEx, who just passed away today, started FedEx when he was 26 years old. So, the most important companies are also being created by young people. So I'd say that it's important to keep that mindset of trying to look at the world through the eyes of someone who's 20. It doesn't mean that you have to live life as if you are 20, but I'm saying that you have to look at the investment landscape through the eyes of a 20-year-old. We actually keep a running calculation of granny shots and said, what would have happened if we don't go equal weight? So NVIDIA, not Nokia. NVIDIA was at the original list inception at like $19. And NVIDIA is 100 and something. So we didn't rebalance it. That's, more than a 10 times gain in the portfolio. And, many names like Tesla were also in the original list. But surprisingly, I don't think it made much difference in the total return of the portfolio. So Ken, I don't know if you have that chart and if you want to pull it up, but I'd say that the only divergence started to happen in 2024. But for most of the life of Granny, it didn't make a difference. What's apparent to us very evidently is the security of energy is important. That was an early theme in Granny Shots. And then we expanded that to include cybersecurity because, as one could even say, cybersecurity's usefulness and importance is growing exponentially to AI. So I think the term is orthogonal to it. But the third is, of course, now sovereign security, securing your borders and supply to power AI and everything else. And I do think nuclear fits within that, but also any technology that innovates the generation or improvement of power generation, whether that's ceramics or other things that are efficient. So definitely. The one thing, of course, is that we have to make sure a name to be a granny shot has to be linked to more than one theme. So something purely nuclear is going to be important for a theme, and someday we might have a pure theme-based fund called energy security. But if it's not, it's unlikely to be a granny shot.
Tom Lee's insights cut through the noise and challenge the narratives driving mainstream market sentiment, from debunking the myth of an all-powerful Fed to highlighting overlooked structural shifts, like stablecoin adoption and long-term innovation trends. Lee offers a data-driven roadmap for forward-looking investors. The real edge? Stop reacting to headlines, start decoding the deeper patterns shaping the next decade of markets. Asterisk explore deeper layers, click and continue watching.